and welcome to this live programme from Baillie Gifford, the latest in a series of webinars where we talk to the managers of the business's different investment trusts. Today we're talking to Spencer Adair, manager of the Baillie Gifford Monks Investment Trust, and we're exploring a three-dimensional approach to growth. More on that to come. My name is Natalie Breen of Citywire, and I'll be talking to Spencer about how he runs the trust. Spencer, welcome and thank you for joining me.
Hello, Natalie. Thanks for having me.
Monks is approaching its centenary, and it's probably fair to say that it's been through an incredible amount of change during the decades. What have you learned from the history of the trust overall, and how can you apply this to the current management?
Certainly, yes. So we were founded in 1929, and soon after foundation, we had the Depression, and then we had the Great Wall Street crash, and the bank that issued Monks went bankrupt. So quite a rocky start. Baillie Gifford took over managing the trust in 1931. And since then, we've been through World War, the Cold War, lots of ups and downs, recessions, depressions, emerging of China, the emerging of Japan. Really great changes in society, great changes in industry, and great changes in finance. And we'll be 95 not out next year. So the countdown's beginning to the kind of raising of the glass in 1929. Some lessons from history. We have retained a long-term outlook and approach. So despite all that volatility and changes, we've always been long-term. We've always prioritized capital growth over income. And what's constant is that we've had to be open-minded about where growth is going to come from in the future. So we pick well-funded companies from anywhere around the world with sound structural growth prospects. And we let the companies do the heavy lifting in terms of wealth creation. Now, if I look back in the portfolio in the 70s, our largest holdings would have been the oil majors, Shell and BP. In the 90s, it would have been GlaxoSmithKline and Vodafone, so pharmaceuticals and telecoms. And then today, our larger holdings would be Amazon and Microsoft in technology, but also CRH and Martin Marietta in building materials. So the nature of growth changes, but the focus looking for growth does not change.
I think we'll dig into some of those changes and how you're capitalizing on the opportunities that it's presenting in a minute. But I guess let's get a bit of a snapshot of where we are at the moment, because the last time you joined us for this webinar, you were quite self-reflective and even quite self-critical of the year that you had through 2022. Could you give us a little bit of a snapshot or some oversight as to how you're feeling about the teams and your own performance during this year?
Look, I'll always give our shareholders honest, straight talking assessment of performance. So yes, having seen NAV fall from something like 23% over the calendar year 22, I certainly wasn't going to pretend that we did nothing wrong. So we made some mistakes, we admitted them, including coming here, and we adjusted the portfolio. The worst thing we could have done is buried our heads. Now, we report net asset value of the trust every day, and as of yesterday, our net assets were £11.29, and that equates to just over 7% growth year to date since the beginning of 23. So I note I'm talking here in calendar years, not financial years, but that's where we are. All of that 7% growth has occurred in the last month or so. So we've had quite a short, sharp rebound in growth company performance as the market's beginning to think that inflation and long-term rates may have peaked. So the first half of calendar year 23 continued to be difficult, but the second half so far has been far better. Now, 7% growth, if that continues for the rest of the year, will mark a much calmer year. And 7% is much closer to the high single-digit, low double-digit rates of net asset growth that we anticipate over the long run. We're still lagging behind the global index by a handful of percentage points, but I'm feeling much, much better on the portfolio companies, how they're performing operationally, and we're seeing improving momentum externally. We've just finished an exercise on the top 20 holdings, all the biggest holdings, and we looked at the potential upsides in the coming 5 years. In contrast to a year ago, there were very few problems, no problems, in fact, in the top 20. So I'm happy to back them all, some of them with more capital. And these top 20 are a sample of the wider trust, but of the top 20 we looked at, their revenue and earnings are forecast to grow almost 3 times faster than the index. So over 15% forecast earnings growth over the long run, the index growing at about 5. That's as wide a margin over the benchmark as I can remember at any point in my investment career. So just under 3 times the growth for a modest valuation premium is exactly how I want the trust to be positioned. And if I look at the holdings, about 70% of the holdings are trading below their long-term 10-year average valuations. So that's a really good, we've got the trust into a really good shape.
So it's encouraging that you're coming back to a relative state of calm. That must be, we haven't had this for the past few years, really. So yep. Your team's well set up to capitalize on this.
Yes. So the team are out traveling a lot, meeting companies, and as you know, we put each of our companies through this this framework, 3 different types of companies, the 3 dimensions of growth. So we're out looking for roughly a third of the trust and a third of the names we're looking for comes from the get rich slowly stalwarts, the compounders. These are established, durable businesses that are self-funding, that have got deep moats, and that grow their profits 10% a year over the long run. Companies should be happy to own in almost all environments. Most of the growth comes from top-line expansion, but a bit from margins grinding hires and buybacks. Well, we can get this wrong if society turns against a product. So just under 20 years ago, when we started investing this way, we had a couple of tobacco companies. We don't have those anymore because society's pushed against tobacco. We'd also get these wrong if management hubris gets too high and they do a large deal or something. So that kind of power of long-term compounding is really underappreciated. Current examples holdings would include Microsoft and software, Estee Lauder and makeup, Pernod and spirits, and we've met all 3 of those in the last few weeks. The second kind of dimension would be these rapidly growing upstarts, growing 20% a year, often innovating, creating a new market. The founder's still in place, making ambitious moves to realize their vision. They can require external capital to grow, so we tend to keep quite a lot of dry powder in case they need that. Operational excellence and managing growth are headaches, and we look for skills in those areas. These can go wrong by just not executing well. So growth here is a real combination of top-line growth, but also very rapid material margin improvement as they scale. Offset to an extent by issuing some more shares. It's the power of disruption and it's the value of the novel that are really underappreciated. So recent meetings or recent companies that we've been talking to there include Spotify in music streaming, DoorDash in food delivery, and Schibsted in Scandinavian classifieds. Then finally, a third of the portfolio is in the more cyclical businesses. These are more mature but brilliant at what they do, and they're run by really skilled capital allocators. They're capable of 15% earning growth over the long term, but that's not delivered as smoothly as the first 2 categories. We expect periods when profits will fall, particularly if the economy is difficult. And what we're looking for here is a management team who keep investing during these difficult periods. When the cycle eventually turns, these are the teams that set up the opportunity for really superior, supernormal growth compared to their peers. So it's often 1 step back, but setting up for 3 steps forward. And it's the value creation of being counter-cyclical there is really underappreciated by the market. So recent examples include Site One in cheap flights, Ryanair in cheap flights, Site One in landscape gardening supplies, and TSMC in chip manufacturing. So that's what we've been up to. We've been out looking through the world through this 3D lens.
Fantastic. So we've touched on the fact that it really has been a turbulent time in terms of performance, at a market level as well as the investment trust. Could you give us an overview of where we are at the moment and how you see Monks emerging from this period? How are those companies that you've just talked about, how are they going to help you kick on for the next 5 years?
Yeah, Look, I think turbulence is quite a polite phrase for it. I think we delivered one of our best years going into the pandemic, and then one of our worst years ever coming out of it. So performance has been much more volatile than I wanted, and I know we've tried the patience of our shareholders. I'm taking quite a lot of comfort from a calmer period, good operational performance coming through. We've got the portfolio in balance, exactly a third in each of the three buckets, which is what I wanted to do. And we've been working hard to constantly upgrade the portfolio. I'm excited about the kind of aggregate trust level statistics. So if I try to think about the whole portfolio, we have got superior pricing power in our companies, as evidenced by superior gross margins. We're much less indebted than our peers. The average listed company is over 2 times more debt than an average Monks company. And that's been a hidden advantage, which is really becoming very real as the cost of debt rises. 97% of the portfolio is self-funded. EPS or free cash flow positive on a forward-looking basis. There are 3 companies which are not. They are under extreme extra scrutiny. I suspect one of them will be sold before the year end. Going into the pandemic, about 90% of the portfolio was fully funded. So we're big improvement there. And then, as I noted earlier, our companies are just growing structurally much faster. So 2 to 3 times the rate of their peers, the greatest rate for many years. So the companies are naturally resilient. They're pretty adaptable. They're lowly indebted. They're growing faster structurally. So why has the share price been kind of range bound between 9 and 10 pounds a share? I think what's been holding the NAV flat is that we've had rising bond yields, and that's depressed the net present value of future earning streams. You can see that effect in most long-term assets, from property to long-term government bonds. If I think about what's been adding or subtracting from performance most recently, shorter term, we've had really strong contributions from the likes of some of our cyclical holdings, CRH and Martin Marietta. CRH re-domiciled in the US, so we've got a kicker of both strong growth and a re-rating. It's trading at a big discount to its American peers. We've had a good kicker from the likes of Ryanair in low-cost flights, continuing to sign up, transport more and more passengers around Europe. And they may start putting up their fares, which would be another unlock. And we've had strength from some of our disrupting companies. So growth is really powering through in the likes of Li Auto, who haven't missed an operational beat in China. That's a hybrid and electric car maker in China, operationally fantastic. Shopify have announced plans to have less capital-intensive growth, big boost to share price. Probably the single biggest thing that's hurt has been the holding in the Schiehallion Fund, which is our how we get some of our unlisted exposure. And I've got 2 reasons to not beat ourselves up too much about that. First, the valuations of unlisted companies have been reset a lot lower. Schiehallion recently did a funding round on one of its companies, and that company was valued at 8 or 9 times net profit. So this is no longer multiples of revenue or EBITDA, but actual net profit. Perfect. So I don't think we can find that kind of growth cheaper anywhere else in the world, but in the private sphere. And secondly, Schiehallion's NAV has widened very dramatically in the last 12 months, up to maybe 60% discount at one point. The board of that trust, that company, has taken action. They announced a buyback recently. We really welcome that, and we're pleased that the discount is being narrowed quite quickly. So that would be, that's what's been going on. Finally, for me, one of the aspects of our history, Billy Gifford's history, is that we have been through periods of high inflation investing before. And we can look at how did our largest or longest standing client fare during periods of inflation peaking in the past. And, frankly, inflation peaking sets up really strong performance of the next decade. So after inflation peaked in 1952, the next 10 years delivered 17% per annum compound returns. In 75, it was 15% for a decade. In 1980, it was 21% for a decade. So you see this pattern here. If we're close to a peak of inflation, that tends to herald a strong run for growth equities. So elevated inflation does not kill off growth. I think it does cause short-term pain, but that pain's really a coiling of the spring. And that's really helpful as the spring then springs back. So if history's any guide, we should be repaid for our loyalty during this flattish, difficult period.
I feel like this is certainly the first time that perhaps, in one of these sessions that we've started to talk about that spring releasing, which is quite an interesting time. It must be, on a personal level, it must be quite an interesting time for you as an investor to start to feel that release.
Yeah, I think we've had, we've had for a while, we've had the companies performing strong operationally, but we've had lots of sentiment and lots of valuation compression hiding that progress. And then it's almost in the last few months we've had growth as expectations of inflation peaking out and now, but are we close to the peak of where we're going to get to in interest rates and long bond yields? We're now seeing that mood changing quite quickly. Nothing's really changed at the company level, but just the market's decided to value them differently, which to our minds closer to where they should be valued. And we're even seeing, we even had a bid for one of our companies from private equity this week or last week. So these are the kind of signals which are just suggesting to me that you never want to call the top on these things. But if inflation has peaked, it feels like something's been released in the last couple of few weeks.
So it looks like underneath potentially the headline numbers that the portfolio, you've managed to get the portfolio in really robust health. Yep. You've talked about allocating your companies into the three buckets, the three-pronged approach to growth. What are some of the other structural changes that you and the board have been up to recently?
Yeah. So just for clarity, I am the manager at Monks, and I report to the board, and the board represent you, the shareholders. Everyone on the board is independent. They've got a great range of experience from fund management, private company investing, real world business, and academia. So what they've been challenging me on the quality and health of the portfolio. So they've been challenging us to continue to improve the portfolio. So one indicator is pre-pandemic, the return on equity in the portfolio was 14%. Today it's 19%. So although we haven't been rewarded in share price terms yet, we've been constantly upgrading, and they've been helping us drive that. Secondly, as the discount NAV has appeared and widened, we've been buying back a lot of shares. I think we've spent £300 million approximately on buybacks since January 22. That's about 12% of the trust. We are very happy to buy back shares. That has added approximately $30 million of value by buying back those shares. We issue shares at a premium, we buy back shares at a discount. And we're very happy for that to continue. And then thirdly, we locked in very, very low cost debt, 1.7, 1.8% debt locked out for the very long term, 30 plus years. We are working on other ways that we can lower the cost of the remaining debt. So those are the big things they've been pushing on challenging the portfolio, improving the quality, buying back shares at a discount aggressively, and continue to do so, and also locking in low-cost debt as a structural advantage for both this and future generations of savers.
Let's turn to look perhaps at the market at a wider level. I guess your approach could be described as being out of step with the market. Why do you think that is? And why do you think the market has so many blind spots at the moment?
Well, the market's not daft. So the market's focusing on what's straight ahead of it because it's pretty dramatic. So it's thinking about the tragedy of war, which is on our screens. It's thinking about the severe cost of living crisis. How are people going to have certain demand, or how can people pay for certain products? There's upcoming elections in the US and UK, which will get noisier as the year goes on. And in the meantime, investors are getting 5% from sitting on cash. So, you get rewarded for the first time in a long time. You actually get rewarded from sitting on cash. So I understand all of those things. They're rational. We've been in the background, calmly, quietly, reappraising, upgrading, and getting really excited about areas of growth we don't think the market fully sees yet. So there's 5 of these, so I'll be quick. The first is that a lot of the technology companies have built up really significant user scale, but haven't really been focused on making a lot of money. And the first one that started this was Meta, the old Facebook business. It slowed down how much it was going to invest in the metaverse. And that's led to roughly a tripling of the share price in the last 12 months. So despite that tripling, Meta remains on about 16 times core earnings pre-growth spending. And we're seeing that kind of same sober demonstration of profitability from Spotify, from Amazon, from Shopify, Adyen, DoorDash, Lemonade. There's a lot of these companies that are just saying, okay, I've built up user scale, now I'm going to turn on profits. And the market is slow to react to that. So perfect. The second big thing that we're excited about is this drive to renew, to repair, to replace infrastructure is getting stronger and stronger. Now, some of this is just replacing the old buildings and infrastructure that were built during the boom of the 50s, 60s, 70s. So they're getting old, they need to get replaced. Some of it's about fulfilling the need for more affordable housing. Some of it's driven by having the need to electrify transport and upgrade the grid for more renewables. Some of it's also, though, a geopolitical desire to have key technologies manufactured onshore, particularly onshore US and Europe. We want to be a bit less reliant on China for key medical and semiconductor technologies. And then finally, a lot of the bottlenecks in growth in technology are actually increasingly physical. So it's not software anymore, that's the limit, it's how many servers do you have. And AI and cloud computing need a lot of physical data centers. So we're seeing this really large wave of seeing this really large wave of demand coming through, and with multiple drivers, and it's amplified by significant stimulus packages. The US alone, I think the packages account to just over $2 trillion. I put that into context. The Marshall Plan to rebuild Europe after World War II was about $200 billion in today's dollars. So 10 Marshall Plans of stimulus coming through to improve. So bottlenecks and money are not money and desire are not the bottlenecks. It's trained people, it's permitted planning permission land, and it's raw materials. And we've got a lot of holdings. We've identified those bottlenecks. We've got a lot of holdings that help solve those. So it could be CRH in aggregates or cement. It could be Nexans in high voltage electric cables, advanced drainage in storm drains to protect us from extreme weather, but a relatively new holding, Comfort Systems in air conditioning and electrical engineers, Persimmon in house building. So that repair, renew, replace is big and really material. The third thing that people think are missing is that companies with strong pricing power keep putting up prices, even if inflation has peaked. Moody's, I think credit rating costs between 50 and 100,000. Because rates are higher, a firm can save millions of pounds in lower interest rate costs by having a Moody's rating. We met the senior management team on Martin Marietta, a US aggregates business, last month. They have not cut aggregates pricing since the 70s. They are now putting prices up 2 to 3 times faster than normal. So these, companies are continuing to do that. Fourth, I think the area that people are missing is that a lot of companies have got capital advantages and are able to deploy it towards the bottom of whatever this cycle is. So Process and Schiehallion in growth investing, or Royalty Pharma in drug royalties, are filthy cheap at the moment in terms of their ratings. So Process and Schiehallion, big discount to net asset values, both buying back shares. Royalty Pharma, single-digit PE for a dominant industry leader, deploying 10 plus billion of capital. And then finally, for me, the fifth one, which is the final one, is a lot of long-term brands who've got strong heritage, strong pricing power. There are near-term demands, fears around these, and some of these long-term brands are trading at multi-year low, 10-year lows in terms of their valuations. I don't think anything has fundamentally changed. So we've got Pernod in spirits, we've got Yeti in outdoor goods, Shiseido in makeup, LVMH and Richemont in luxury goods. These are all trading at very low multiples of sales and profits compared to history. So what am I excited by? 5 areas: tech, profit, turn on, renew, repair, replace, capital advantage companies, long-term brands, and pricing power. These are the big blind spots the market's missing.
Really interesting answer, Spencer, and great to see how you're interpreting the market. I'm going to turn very quickly actually to a question from the audience because it kind of relates to this. And thank you to everybody that's submitting questions. Please do keep them coming in because shortly I'll be turning to the audience questions segment of this session. So please keep them coming. But one caught my eye, which says, is your job essentially to try to see the future? And I guess from your answer just there, it strikes me that it's a little bit about seeing the future, but it's also about interpreting the signals that you're being presented with at the moment and perhaps interpreting them a slightly different way.
Yeah, I think you could. I'm not a futurologist because they sit and they dream up what the future is going to be like. What we're trying to do is see where are there areas of underappreciated growth? Where are we seeing structural growth appearing that it's not priced in to share prices? So it's a combination of both. Can you identify the growth, but also can you work out what the market might be missing? So it's not quite future. It's also trying to it would be easy to predict the future but you may not make any money if it's fully priced in, and that's the additional bit of my job.
We've kind of touched on this a little bit, but perhaps it would be good to just get it in, I suppose, in kind of clear terms here. Obviously, we've talked a lot about there being change and opportunities, but what are some of the trends that you're seeing and really trying to capitalize on? You touched on that in your kind of 5 areas, but seeing as you're looking for such a wide remit, you're looking globally and you're not just you're looking at everything. So how do you kind of pair that back to some interesting themes and trends?
I think most of the trends that we're picking up are you're trying to find things which are durable. So we're always trying to dismiss or work out behind whatever the hot trend is. What's the real bottleneck? What's the real thing that's causing a shortage? And if you can identify where the shortage is going to be in an area of change, then that's where you'd make most money. And this is a theory so far, but I think the last 20 years of growth investing have been predominantly companies where everyone's got very soft hands. So it's media companies, it's coders, it's biotech firms. And increasingly, we're seeing growth bottlenecks in companies where people need hard hands. They're out building things, they're constructing things, and I think that nature of growth is changing, and we are totally open-minded to it. But I would growth investing is not just about technology investing. That's important and always be there, but it's also about identifying where the big bottlenecks are. And in the 70s, when Monks' larger holdings were Shell and BP, that's because that's where the bottleneck was. It was, we're not going to be able to have the energy we need. In the 90s, when it was Glaxo and Vodafone, it was Vodafone, it was the mobile computing beginning, and that was the real bottleneck that we're trying to exploit there. And so growth investing evolves and continues, and I think it's becoming more physical and more construction real world driven today than it was 10 years ago, certainly 20 years ago.
I can see from some of the questions coming in that we might perhaps have some newer investors into the trust. So perhaps you could talk us through a little bit about how investors could hold Monks within their wider investment portfolios. How do you see that kind of sitting into the wider scheme?
Yeah, so we exist to generate capital growth. We are a portfolio that's well diversified, just under 120 different companies, split equally across those three growth areas that I talked about. Got modest exposure to unlisted companies. The majority of this trust is large listed equities. We will issue shares if we're trading at a premium, and we will buy back shares if we're trading at a discount. So we will try to keep the share price and NAV as close as possible. You can't guarantee that, but we try our best. So we try to be counter-cyclical. We are always small c conservative. So we've got a pretty modest caps on unlisted and on gearing. My target gearing is 10%. Whenever things were going swimmingly well, and the performance was through the roof, we let gearing drop to 1%. So whenever things were going so well, we took the foot off the accelerator. And now it's taken a couple of years of difficult markets, but we've now got gearing back up to around 8%. So if that's an indicator of how enthusiastic we are, we're kind of getting right back up there. We will not track a global index. We will be different in the index. Our active share is high. And so in any short-term period, we're going to be different in the index. That's okay. We just use the index as a broad indicator of global returns. We like being differentiated. And I think we're more differentiated now in our views than we have been for some time. This is how we invest. So I hope that helps a bit. In terms of use us for capital growth, we are already quite diversified, and we spread the growth across three different flavors or buckets, dimensions of growth.
We haven't really talked much about the unlisted holdings. So perhaps you could talk us through your allocation to private companies and the portfolio at large.
So we have 10% permission from the board. We have permission from the board to go to 10% in unlisted holdings. Currently, we're about 4%. We've been slower than other trusts to use up our capacity, partly because we're more conservative and partly because we've been waiting for an opportunity. The biggest holding in unlisted is Schiehallion, which is another fund. It's trading at a large discount to net assets. Perfect. So that's great. And that's just over half of our unlisted exposure comes from Schiehallion. On top of that, some of our larger unlisted holdings would be ByteDance, which is the owner of TikTok, SpaceX, which is Elon Musk's rocket company and satellite company, Epic Games, who run the Fortnite franchise, and Stripe, who do kind of payments for large e-commerce businesses. All of those are large companies. Many of them are close to, or many of them could be listed if they wanted to be. They choose to remain private. So some of these valuations, these companies are well over $100 billion. These are not small incremental businesses. These are large, serious enterprises that simply have not listed yet. And so I would anticipate 1 or 2 listing in the next 18 months. But even if they don't, they are large, self-funding, and continue to perform operationally well. We've got a few smaller holdings, but they're less than 10 or 20 basis points of the trust. So that's the majority of our unlisted exposure. Given where we are in the cycle and fear towards unlisteds, I am open to business. I'm looking for other ideas. Nothing is immediate. No immediate plans, but we'd be looking to allocate money counter-cyclically to an area which has been out of favor.
Great. Let's turn to look at how you incorporate ESG into your holdings. That's not something we've really touched on. Could you give us a little bit of oversight as to your approach to ESG and ESG analysis of your companies?
Yep. So whenever I take a holding for Monks, I'm thinking my base case is I'm going to hold this share for 10 years. And whenever you have that time horizon, you're naturally drawn to, how's this company governed? What's the structure like? Does it do good for society? What's the environmental impact? But ESG, because of our long-term time horizon, is embedded in. On top of that, we have our process includes specific ESG questions for every company that we buy. We have a specialist ESG analyst in our team that helps us with lots of different aspects of work. So ESG is so integrated into the process, I couldn't unpick it. It is, every question is about, is this growth going to be sustainable? And what might get in the way of that? And all of the ESG factors are critical. So it's become so ingrained, it's beginning to disappear because it's just how we do and how we think about investing.
That kind of leads us into another question here, which says, what's Monk's view on the future of hydrocarbons? And I guess, how do your thoughts on that play into the positions that you're taking in companies?
So we've got very few hydrocarbon companies in the portfolio. We have a small holding in a gas company, Australian gas company, Woodside. Of all the hydrocarbons, we think gas will be the last to be disrupted, and therefore having a relatively secure, low-cost approach to a relatively secure, low-cost supply of gas is politically and very desirable. We've looked hard at the big oil and gas majors. We've tried to assess, we've probably met 5 or 6 of them, and we've been trying to assess how they transition from what they do currently to a vision of more electric cars, etc., in 10 and 20 years. And we haven't liked what we've heard. So we are open-minded to thinking that there could be growth from hydrocarbons because no one else is investing, but frankly, we can't find that type of business that we like. So we are much more geared into our holdings in electrification. So we own Li Auto and Tesla in electric cars. We own Albemarle, which is a lithium miner, and we own Nexans, which does high voltage electric cabling. So we're much more on the electrification continuous side of things than the hydrocarbon side of things. One holding, remain open-minded, but haven't found an idea that we like.
Okay, looking, I guess, a little bit future. I know you're not a futurologist, but let's assess one of your holdings, Process, which sits in your top 10. What action has it taken to reposition for the future? I guess this is one of your soft hand technology companies that you were talking about.
Yeah, so look, I had the pleasure of having a meeting the interim CEO at Process and the CFO 2 nights ago, or at the end of last week. I think it was Friday. This is a company that is. This is a company who it's a long-term investor in technology assets. It has a tremendous long-term record, and it's trading at a very big discount to net assets. So it is selling off its shares in Tencent, the large Chinese social media giant, and Tencent itself are buying back shares, I should say. But its Process is selling off its shares there slowly and in a controlled way, and buying back its own stock at a very big discount to net assets. So it has bought back something like 1/3 of the free float in the last couple of years, and it will continue to do so. Because they've just replaced their CEO, they've got an interim CEO, they are working out their longer term vision. So I can tell you what it used to be, but I suspect until we let the new guy get under the table a bit and present his portfolio, I won't say too much about what they're planning to do. it would be fair to say, I think we're expecting quite a lot of change in that portfolio, and we're expecting over time for them to exit some existing holdings and then to build up some new ones. If I had to guess, I think they are really excited about India. They're really excited about finding technology-enabled physical network companies within India. That could be e-commerce or food delivery and etc. But I suspect what we will see there is selling out of a few mistakes that they've made and redeploying that capital into buybacks, but also into new ideas within India, but they haven't done it yet, and there's a new CEO, so quite a lot of caveats around how quickly we see that action.
In our last webinar, you talked about the fact that you felt like you should have been more interventionist at times within some of the companies that you're holding. And you mentioned here today that you've got around 119 holdings. One question is, do you think that's the right amount, given that last year you felt like perhaps you're a little bit slow to make some decisions or some calls on some of the holdings?
So I think that number's coming down gently. We're not, well, I don't want to set an artificial target and move to that, because that doesn't feel, but it's case by case, assessing the upside. If the upside has come through, then we sell, and I don't, and you know, so I think that number has been coming down. I think it will continue to come down gently and naturally. Just as a reminder, although I make a lot of the decisions for Monks, I've got two other colleagues that help me make those decisions, and we're tapped into the entire floor of Baillie Gifford investors, equity investors. So I'm not having to keep every of those 119 names in my head at all times. I've got a lot, like you couldn't do that, but I've got a lot of colleagues that help, and we have regular meetings, weekly, monthly meetings where we keep on top of all the individual holdings. So, but yes, the number of holdings will come down marginally. It will still remain very diversified. I doubt it will go below 100, but it's still, you know, it will come down a bit.
How do you differentiate Monks against Scottish Mortgage? I guess that's, I suppose, in terms of approach, ethos, holdings. What's the difference there?
Look, Scottish Mortgage has been run by Baillie Gifford Investors since 1909, Monks since 1931. So we've been sister trusts for many, many decades. We've always had differences. So these are neither good or bad. These are just facts. But Scottish Mortgage tends to be more concentrated. Monks tends to be more diversified. Scottish Mortgage tends to have most of its money in what I would call our rapidly growing innovators. They tend, that's largely what they're trying to achieve. We've got a broader definition of growth, the cyclicals and the stalwarts as well. We tend to have a flatter portfolio. They tend to have their largest holdings maybe to approach 10% of the trust. Our largest holdings approach 3 or 4% of the trust. We've got a lot less in unlisteds. So I think they're close to 30% in unlisteds. We're 4, which is big difference. Most of our unlisted holdings come through a trust, another fund, not direct holdings, and we're a bit less geared. So quite a lot of differences. We're both long-term growth investors, but we have different approaches to how we think about the world. Generally speaking, those who are a bit more conservative seem to prefer Monks. Those who are a bit more profit-seeking seem to prefer Scottish Mortgage. But you know, over the long run, we think both are strong. So I wouldn't. You know, it depends what the individual investors' preferences are. People are normally surprised because if I look at the direct overlap in holdings, it's only 18%, 18. And I think people expect, because we're managed out of the same investment house, for that to be higher, but they're you know, considerably different from each other in terms of the portfolios. Does that help?
Great. Yes, thank you. I'm gonna rattle on. I know I'm jumping around kind of from theme to theme here, but I think we've got time to squeeze in one more question, which asks, looking geographically, are there any trends that you're picking up from these bottlenecks that you're identifying?
Yeah. Europe and America have not built things for a long time. We've dismantled a lot of our skills, and we're having to improve very quickly. And so, blue collar construction work, skilled work, that is a big bottleneck. And I think that's both a challenge and exciting. And so I think the leadership in our economies may be changing a bit. And if you introduce the threat of AI to knowledge-based industries, etc., I think we're seeing naturally a bit more of an equalization here in the society valuing different skills. And I think if anyone's got spare time, train to be a plumber, train to be an electrician. That's the big shortages which we see coming up, as opposed to coding or engineers or biotech. So things are changing, and they're changing very rapidly. And it's been a long time since we've had a big boom like this. And we're at the early days of it, and there'll be ups and downs along the way. But it was probably after the Second World War we had this big investment in infrastructure, and we're just seeing that creaking everywhere. We're seeing the lack of homes, the lack of building in the UK, for example. We've offshored a lot of our problems, a lot of our manufacturing problems to other parts of the world, and there's now a big political will to change that. So I think an era of de-globalization, or less globalized, is coming. And that means we have to get ready with our own supply chains, our own infrastructure onshore. And so far, America's work is reacting fastest to that. But the UK and Europe are catching up.
Spencer, thank you for that. Exciting times to come. Thank you for your answer there, but also thank you for all of your answers this morning. This is actually the last session for this year, but we'll be running more through 2024. So if you enjoyed today, please do keep your eyes peeled for future sessions. That's all we've got time for today. Goodbye.